In other words, your compensation should be reasonable considering the revenue your company makes and the portion of it that can be directly attributed to you. So how do you pay yourself in an S corporation? According to the IRS, you need to pay yourself a reasonable salary. But what in the world is a reasonable salary? And shouldn't you want to pay yourself the highest salary possible? Like, why is this a thing? Well, it's a thing because by paying yourself a very low salary in an S corporation, you are effectively lowering the amount of taxes you pay. And then on the back end, you can pay yourself with a distribution and not pay self-employment taxes because S corporations don't have to pay them anyway. So stay tuned for this full episode to learn the rules and stipulations regarding how to pay yourself in an S corporation. Hey everyone, my name is Sherman and I am a licensed CPA here at Life Accounting. Our channel is all about helping people save on taxes while boosting profits. So if you want to do that, go ahead and hit that subscribe button so you don't miss out. In today's episode, I'm going to fully explain how to pay yourself in an S corporation. S corporations became a popular tax status because you do not have to pay self-employment taxes on its earnings so long as you pay yourself a reasonable salary. So I'm going to break down what a reasonable salary is and make sure that you understand all of this stuff if you decide to go this route. So first of all, for all the people in the back, what is an S corporation? Let me start by telling you what it's not. An S corporation is technically not a legal entity. When you form your business with your state, there is no option for S corporation. You might be able to choose a partnership, LLC, or C corporation though. An S corporation is a tax entity. I like to think of it as a tax status. Entities like LLCs and C corporations have the option to elect to be treated as an S corporation for tax purposes. For example, a C corporation might choose to be treated as an S-Corp to avoid double taxation because they are taxed on both a business and individual level, while an S-Corp is only taxed on the individual level. On the other hand, an LLC might choose S-Corp status to avoid self-employment taxes because self-employment taxes do not apply to corporations and S corporations would apply for tax purposes. Meanwhile, self-employment taxes do apply to other pass-through entities like sole proprietors, partnerships, and one of our favorites, limited liability companies. So by electing to be treated as an S corporation for tax purposes, you can limit your tax exposure and put that money in other places. With that said, how should you pay yourself as an S corporation? Well, according to the IRS, S corporations must pay reasonable compensation to a shareholder employee, which is basically a shareholder who works in the business. Then they go on to say that this compensation must be paid before non-wage distributions may be made to the shareholder employee. So basically, before you pay yourself or your partners a distribution of profits, you should be taking a reasonable wage from the business. And for these wages, you will need to set up a payroll system to pay yourself through. This is because the wage you pay yourself is subject to payroll taxes like Medicare, Social Security, state taxes, and individual taxes. And although self-employment taxes are not assessed on S corporations, Medicare and Social Security taxes are basically what the self-employment tax is for anyway. So in some sense, you are paying some type of self-employment tax if you are paying Medicare and Social Security taxes. But the good news is that you do not have to pay self-employment taxes on the business income. You're only paying these taxes on the wages you take from your business. For example, if your business made $150,000 in profit and you paid yourself $50,000 in wages, then you would only pay Social Security and Medicare taxes on the $50,000 you paid yourself in wages. The remaining $100,000 would just be subject to federal and state income taxes. So by electing S-Corp status, you would avoid a 15.3% tax on a big portion of your income. But while the tax savings are clear, what is not so clear is the whole reasonable compensation part. This is what trips up most people in an S corporation. They either pay themselves too little or don't pay themselves at all and take distributions from their business. But this doesn't come as a surprise though. The guidance by the IRS is very gray when it likely should be black and white. The IRS does not provide an exact amount or percentage of how much you should pay yourself as an S corporation, but they do give you some factors to consider, like the person's training and experience, time devoted to the business, or what comparable businesses pay for similar services that the shareholder employee provides. So basically, consider what you would pay an employee to perform the exact same job responsibilities that you perform. For example, if you are the CEO of your company, what would you pay to hire someone as the CEO to replace you? Considering that some CEOs make as little as $100,000 per year and some make as much as $50 million per year, this might be a huge concern to you. But keep in mind here that everything is relative to your company. The IRS is looking at the source of the gross receipts of your company. In other words, your compensation should be reasonable considering the revenue your company makes and the portion of it that can be directly attributed to you. The IRS says that payments should be classified as wages to the extent that gross receipts are generated by the shareholder's personal services. Okay, so this might sound really good, but if you're sitting here watching this video, really trying to figure this out, you might still be a little unclear on this. So after reviewing some court cases and talking to other CPAs on this, let me give you the general rule of thumb to follow. In general, reasonable compensation for a shareholder is about 1/3 of the net profits. So if the business earns $100,000 after expenses, then a $30,000 salary may be considered reasonable, or a $100,000 salary if the business earns $300,000 a year in profits after expenses. This, of course, may be modified based on your unique circumstances. For example, if you're only working in the business part-time, then perhaps you're really not responsible for generating much of the gross revenue the company makes. In this case, you might rationalize a lower salary to take as wages. On the other hand, if you have no employees and literally run every aspect of the business, from sales to marketing to the delivery of your products and services, then you might take a higher salary as wages. But ultimately, the general rule of thumb that almost every CPA that I've talked to has been 1/3 of net income. But what do you think a reasonable salary is? Let me know what you're thinking in the comments below. And if you enjoyed today's video, let me know by clicking that like button as well. I'll see you in the next episode.